Now, you will remember that when I speak about these economists, even like David Ricardo or Ludwig von Mises in 1912, he wrote that book in 1912. In 1912, the United States didn't even have a central bank. The US Fed was only founded in 1913. So that was the time actually of a gold standard. So you may ask the question, like, how did these economists, come up with these theories? That was even before we did have a gold standard. Central banks did not have the freedom they have today, if they even existed. Again, and the United States didn't have one. So here's I will only explain this briefly, but the point here is that even under gold standard conditions, the banks were able to print money. And this is what I said earlier. When gold is money, even in times when money proper is gold, banks usually issue fiduciary media. They issue banknotes that are not covered by gold. Although the banks usually promise that they exchange the banknotes for gold, they're not fully covered. So I think in even most gold standard systems, somebody in the economy, usually the banks, manage to issue financial assets that trade like money, that are being used like money. And to the extent that the public uses this as money, it is money, and it expands the money supply. So there was an element of elasticity already even under gold standard conditions. And this is fine. I mean, I don't think this is in itself a major problem. It's only, the economists only said, this is what it is, but it does mean that you have a business cycle. Because ultimately, at some stage, the banks expand their balance sheet, create these banknotes that are not covered by gold, that creates a boom and then a bust. So you have a cycle. Now, the only difference is now for our system today is that we have now done away with the gold anchor. So what this means today is we have the same phenomena that all these economists described, injecting money into the economy, causing these short-term growth effects that then turn into recession. All that still happens. But when the recession kicks in, because people want to go back to money proper, they de-lever their balance sheets. They don't want to use the banknotes from the banks anymore because the banks may be in trouble in a recession, so they want to rather have gold again. This process of correction is now being short-circuited or aborted by the central banks because we don't have a gold anchor anymore. The central banks are under complete discretion to print more money whenever the system rolls over. So you have a boom, and when the recession comes, well, we don't have a recession because the central bank lowers interest rates again and prints more money so that the banks continue to expand. So what you have in such a system is you have managed recessions. And this is one of the reasons why since the 1970s, most recessions have been so fairly shallow. They have not been as dramatic. And I think many people who support this present system and are very critical of the gold standard, as most economists today are, they always say, well, in the 19th century, business cycles were much sharper. Yeah, I agree that there was probably more volatility. Overall, the economy grew very nicely, but there was volatility in economic performance. But it's easy to see why our monetary system for so many years and even decades looked fairly stable. Because we expanded money supply, we created this boom, but in the boom there's certain imbalances, as we economists would say, accumulate. People take on extra debt. The misallocation of capital that is always the consequence of an artificial money-induced boom. That all still occurs, but we've done away with the cleansing recession. So the banking system never really contracts. It expands. And when it wants to contract, or when it runs into problem, we give them easy money so they expand again. So and I think if you look at this is the key change now. So if these economists were right, and I think they were right, that elastic money, constant money injections into the economy, lead to short-term booms, but then to busts. They lead to economic instability. I think then the logical conclusion would have been to make the monetary system less elastic. I mean, some economists have argued that you should stop fractional reserve and force the banks to not expand their balance sheets so much. That would be one approach. I'm not necessarily in favor of this, but this is what has been argued. But at a minimum, economists would have said, you need to stick to hard money. If money at the core of this financial system is hard and not elastic, then that means if the banks have overstretched, at some stage they need to go back. And they will learn their lesson. Next time the boom comes, they maybe will be more cautious, or maybe not. But after a while, the system will liquidate the imbalances. and will go back to a more balanced structure. And I think the key message here is that we've gone the other way for political reasons. We've not made money less elastic, we made it more elastic. For the same reasons that I said earlier, politicians always like paper money, and states have always ultimately drifted towards paper money systems, because you can fund the state more easily and you can print money. And you can, if you want to, you have, you need there are elections, you need to buy voters, you can print money to make everybody feel better and have the economy grow again. So the state did not want to give up that privilege of printing money. But that meant we made money more elastic, not less elastic. We gave the banking sector a backstop, a lender of last resort. And so it's very clear, so if you look at it from this angle, then the question becomes, so if you have such a system in which you never allow a deflationary correction, which you never allow the money supply to contract, if you never allow the economy to properly liquidate all the misallocations and imbalances and distortions that have accumulated in an artificial, money-induced boom, if you never allow the liquidation, what does it mean? Well, it means that whenever you go into recession, you need to lower interest rates again, print more, but it also means that banks will get ever bigger, ever more overstretched. There is an incentive, obviously, for the banks to extend their balance sheet, because, as I said, whenever they want to delever, whenever they're in trouble, they need to, and want to cut back lending and reduce their balance sheet, it would mean a recession. We don't want that, so we make them lend even more. Now, it's very clear that I think, and this is what I argue in my book, that this process must have an end game. This cannot go on forever. So what's the end game? And I think it's very clear that if you look at the economic situation today, the major imbalances we see around the world can only be explained, certainly I think can only be explained in their magnitude, on the basis of a fiat money system. Because what are the problems around the world? It's weak banks around the world. We have a banking crisis globally. Banks have low capital ratios and less cash reserves than they probably had at any time over the last 30, 40 years. Around the world, there are banking crises. All central banks are now, as I said before, are zero interest rates. In Japan, in Britain, in the Eurozone, in the United States. All central banks, because the banks are no longer able or willing to lend, because they're now so overstretched and they're concerned about their capital base, that the central banks themselves now go out and start buying the assets and put them on their balance sheets. We see this in the Eurozone. I mean, the ECB had a balance sheet of roughly about 900 billion euros when the crisis began in 2007. The balance sheet of the ECB is now 3,000 billion, so 3 trillion euros. The US Fed had a balance sheet of about, well, if I remember correctly, 800, 900 billion US dollar. The US Fed is now very close to $3 trillion balance sheet as well. The one central bank that has expanded its balance sheet most is the Bank of England. The Bank of England has more than quadrupled its balance sheet. It's the queen of quantitative easing. And what it now means is obviously that more and more assets out there need to be supported, directly by the printing press and by the central banks to stay at these elevated levels. Because it's very clear that the three phenomena you will see at the end of a super extended credit cycle, the one we had, are, as I said, weak banks, overstretched banks, excess levels of debt. You see this around the world. Excess levels, all economies are suffering from excess levels of debt. And the third one we're seeing are distorted asset prices. Almost all asset prices have gone up for years and decades. Equities had a great run. Bond markets had a great run. Most real estate markets have gone up tremendously because these are all assets that the banks can easily use as collateral whenever they're expanding. So I think the financial system that we look at today, in all its imbalances and distortions, can only be understood as the outcome, as the direct consequence of such a fiat money system. In a way, the system had to do without the cleansing recessions for decades, and is now practically in need of some super correction. And obviously that is politically so painful and is politically so deemed unacceptable that I think now all these central banks are doing whatever they can to keep the system going and avoid a correction and collapse of the system. Because now nobody knows how big that recession would be. How big would the correction be? How many banks would go under? How many states would go bankrupt? What would asset prices be? What would happen to real estate markets? What would happen to pension funds? We don't know. So the fear is because we've avoided the near-term pain so much, we always pushed it further down the road for years and decades, that now the system has checkmated itself. It's so distorted that it now needs this massive policy support just to keep correcting. And obviously a lot of people say that there is a risk of deflation and the economy is not growing well, despite the fact that central banks are expanding their balance sheet and keep interest rates at zero. But that's, again, understandable because they need to push ever harder to keep the system just from correcting, let alone have it expand further. They need to have these extreme measures just simply to avoid the deflationary correction that the system creates. Because if the market were allowed to operate here, the market would liquidate. It would liquidate debt that will never be repaid. It would take banks out of business that at the end of the credit boom are no longer needed, or that have overstretched and overextended. But now everybody is too big to fail. Nobody can allow the system to crack because you don't know how far the system would now cleanse. And this is sort of the point we've maneuvered us in.